Good morning, this is Jeff Hildebrand. This is Jeff Hildebrand for TBL Traders. Today's video is going to be on neutral or non-directional option strategies. I'm going to talk about 2 or 3 possible strategies. What's important to know about neutral strategies is you enter them under 2 conditions. One, you expect to earn money on the decrease in volatility. You expect to take premium. The other is you expect a breakout or a breakdown, but you don't know which. So you're neutral on a directional basis, but you expect something to happen. I'm going to take a little time and look at each one of those 2 cases and give you an example for each case. In the case of an increase in volatility, meaning you're bullish, okay, you expect the stock, in this case we're going to look at Netflix, to break out or break down, but you don't know which. That's still a neutral strategy. The strategy you use for that, one of the strategies you use for that would be a straddle, a long straddle. It's a very popular strategy for beginners, but a much more dangerous strategy than it appears. Why? Why is it a dangerous strategy? Because you are paying a lot of premium, in this case $18, $19 on each side. A long straddle is where you buy a put and you buy a call, usually at the money, but you can buy a put and a call at the same strike, higher or lower, basically moving this chart left or right. So in this case, a long straddle, you have unlimited potential for profit, which is why beginners like it a lot and why it's an interesting trade if you call it at the right time. You pay a lot for premium. So I'm going to look at the range. The range for break even here is between 390 and 465. So here's your range for break even on a long straddle. Okay, it's a huge range. I often use average true range to get an idea of what the daily range would look like. So you see here 5, 6, expect it to move 5 or 6 points in a day. To get outside here or here, the trend isn't going to do it, probably. You're going to be looking for a breakout or a breakdown. The other thing I look at to sort of evaluate this type of strategy is the pricing of the options, obviously, and that's a complex subject, but to give you a quick idea of where we are with volatility, it's low and declining on Netflix. That will translate into lower option prices, and again, it's more detailed subject than that, but it'll give you a quick idea of where the option pricing is, whether they're historically low or historically high. Straddles, when you buy long straddles, you try to get the best price on the puts and the calls you can. So if you have very high, if you're historically, if your volatility is very high, your option prices are going to be high, and a long straddle is even going to be more expensive than it is normally. So again, that's what it looks like from a profit and loss perspective. The range is very large. You have unlimited upside, which is very interesting. That's when you expect a breakout or breakdown. You can also use a neutral strategy, which is a short straddle, and in this case you basically sell the same instead of buying them, and you take profit right away. 36 grand is what your max profit will be, and the range is the same. Risk is, and the problem is, your max loss is unlimited, or the max loss can go all the way down to 0 here. So you risk a lot on this trade. You expect it to expire within this range. Same as the long straddle, but you're expecting it to expire within this range, not break out of this range, and then profit on the premium that you received. Again, this is a dangerous, very, very dangerous trade. There is a better trade for a neutral strategy to earn premium, to earn, to earn on the decreasing volatility towards expiration. That would be a butterfly. Now I'm going to show you give you two different perspectives on a butterfly. The problem with a butterfly, if you will, is that your range for break even is much smaller. I cap my max loss. My max profit is around 7, in this case 7,500, 8,000. Max loss is 2,000, not unlimited, so that's already more interesting. But as you can see, I reduce my range. That's my profit range. Okay. The interesting thing about butterfly is they're easily adjusted. So I can move these. I can move this 420 down to 410, move this 440 up to 450, for example. Now I see a max profit of about 14, max loss of about 4, but I've moved my range out a little bit to break my break-even range, 415, 445, and I'm giving myself a little bit more room to make money here. That's why butterflies are interesting. Butterflies are also very easy to adjust. Can't seem to grab this line, but I think you get the idea. I'm moving out my potential break-even range. Anything in between here I profit on. And as I approach my short straddle, butterflies become very interesting. I don't make as much, but I don't risk as much either. And that's the game, basically, to try to risk as little as possible and to be consistent on your profit taking. So in the case of a neutral strategy where I don't expect Netflix, in this case, to move very much, I like the butterfly. I hate the short straddle. On the case of a breakout, or if I'm expecting a breakout or a breakdown, I like the long straddle, but be very, very conscious that it's an expensive trade. So that's about it for the video today. Thanks a lot. If you have any questions, don't hesitate.